thanks to everyone for coming, and also thanks to our panelists for agreeing to talk to us about this topic that's center of mind for a lot of people. I guess the first thing to do will be to introduce our panelists. I'll just say their names and titles, and then have them talk a little bit about themselves, give a quick summary. I'll start on the farthest on my left here with Rebecca Middich from Husch Blackwell. Do you want to just give us a quick overview of what you do at Husch Blackwell and it's how it intersects with opportunity zones, what we're talking about today?
Sure. I'm a partner in Husch Blackwell's real estate development and construction group. I'm in Milwaukee. Husch Blackwell is a national law firm. We have 18 offices across the country, 700 attorneys, and about 100 in our Milwaukee office and 40 in our Madison office. I have been involved in opportunity zones since the law was passed at the end of 2017, in large part because I'm an economic development attorney. Most of the work I do is real estate development that requires some sort of governmental incentive in order to get the job done. So development with complicated capital stacks, whether that's new markets tax credits, LIHTC, historic tax credits, TIF, PACE financing. So opportunity zones, this incentive is essentially another layer in the capital stack. As soon as it was passed into law, it's the largest federal economic development incentive in the last 15 years. So myself and various others at my firm dove right into it and have been working in this field for about the last year and a half. Right now we have a Opportunity Zone practice group that I co-lead. That's about 30 attorneys from around the country, which include real estate development, construction attorneys, fund managers, securities attorneys, tax attorneys. This is really, it touches on many practice areas, and so there's not really one attorney that's the only person you need for the job. So we have a diverse team in that respect, and I'm happy to be here.
All right, well, thank you, Rebecca. And then next in line there is Brenda Graat from Baker Tilly. Did I pronounce that right? I'm sorry.
Yeah.
Okay, good. From Baker Tilly, and would you give us a quick overview of your work with opportunity zones?
Sure. So my name is Brenda Graat. I'm a senior tax manager at Baker Tilly, part of the construction and real estate team. I've been with the firm for about almost 17 years now, and with Baker Tilly, we're the top 15th nationally public accounting and advisory firm. When the Opportunity Zone came out, as well as a tax reform provision, we dived into it just to understand the tax nuances as it applies to. We also do modeling for our real estate clients as it relates to the capital stack, just to make sure that they have funding in play. So I think this was a benefit for them as well. As it relates to it, we do have a Baker Tilly Capital team, and with that team, they've actually worked with our real estate developers to go and find investors for projects. So that's been really key for us. So we've been really watching this program. We've also worked with the Treasury itself. So when we look at the proposed regs that come out, and we find any technical issues, we write letters to the Treasury just to see, if additional guidance and corrections can be made.
All right, well, thank you. And then immediately to my left here is Farshad Maltese. I hope I pronounced that right. Is that? Mm-hmm. Okay. And he's with Wisconsin Housing Economic Development Authority. And could you tell us a little bit about your work and how it intersects with opportunity zones?
Sure. My name is Farshad Maltese. I'm the Director of Strategic Business Development for the Wisconsin Housing and Economic Development Authority. WHEDA is about a $3 billion entity, and we do affordable housing and also some economic development lending, and we also administer a couple tax credit programs. The reason that we got involved with opportunity zones was because opportunity zones target our mission area, which is, and it's kind of my primary job, is to find different sources of capital and resources to support affordable housing and also economic development in underserved or low-income communities in Wisconsin. That's kind of our mission, or what we try to do. And my specific job is to find new sources of capital to do those things. The thing that interested us with opportunity zones was just the sheer magnitude of it. OZs will bring about, let's just be conservative, between $3 trillion to $6 trillion of capital gains would be potentially eligible to be invested in opportunity zone. Let's just use the 3 trillion number and compare it, for example, to affordable housing tax credits, about 275 million. New market tax credits between 3.5 to 5 billion a year. So the magnitude of this, of this resource compared to other, federal tax credits just completely dwarfs it. And we really are looking at ways to make sure that we are able to bring the benefits or that investment that can be a potential investment in OZs to support both affordable housing and economic development opportunities in the state of Wisconsin.
All right. Well, thank you. And I guess just for starters here, I imagine most people in the room are somewhat familiar with opportunity zones, but I thought it would be good to get an overview of exactly what they are. And I guess I would just throw that out to any one of you who wants to take it. And then if any of the others feel as if some point has been overlooked, you can elaborate on what the first person said. So I don't know if anybody wants to do a brief introduction to opportunity zones.
I can take it.
Okay. All right.
So,
Thank you.
the Opportunity Zone provision was enacted as part of the Tax Reform and Cuts Act from 2017. And I think the part that was amazing was I felt as though it was a little hidden in the bill itself. There was so much that came out through the enactment, but there was a small niche that created actually a lot of opportunity. And what it is that the governor of each state determined, where do they want economic development to happen in these distressed communities. So a governor of each state was able to designate an opportunity zone, and they had the time to do that. And at this time, there's about 8,700 qualified opportunity zones that are available nationally. Now, to take advantage of the program, a taxpayer has to recognize a capital gain to go and defer. And what they'll do is they'll take their capital gain and they'll reinvest it into a qualified opportunity fund. And they have 180 days in order to do that, to defer their gain. I'm just gonna digress a little bit just because this is really key and important, is that for your 2018 tax filing, if you wanna take advantage of this program, you have Friday of this week, June 28th, to go and invest into a qualified opportunity fund. So that's if you had any gains that were considered December 31st gains, so 180 days from that is June 28th. And December 31st gains would be if you have a net 1231 gain, so that's a sale of property that's related to a trade or business, or if you got a gain from your pass-through entity like a partnership, from there that would consider December 31st, and you have 180 days from there to go and invest. So I would advise that if you did your 2018 filing already and you want to take advantage of this program, maybe just double check to see if this is something that you can invest in. So I mentioned that you're able to defer your gain, and you defer it until December 31st, 2026. So that is key for it. The second thing is you have to invest into a qualified opportunity fund. If you hold your investment for 5 years, then 10% of your deferred gain is forgiven. If you hold it for an additional 2 years, then an additional 5% is forgiven, so you're only taxed on 85% of your deferred gain. So, for example, if you have $100,000 that you decide that you want to invest into a qualified opportunity fund, you hold it for 10 years, then 10% is forgiven of that, so then it would be the $10,000 that's forgiven. Hold an additional 2 years, then that's the 5%, so then the $5,000 is forgiven. So come December 31st, 2026, you're only taxed on the $85,000. So that's the other key benefit of it. And then lastly is that if you hold your investment for a minimum of 10 years and then you sell your investment, then the kicker is that the appreciation on that investment upon sale is forgiven, it's tax-free. So I think that's where we're seeing a lot of benefit in the program itself. So that's just my quick synopsis.
Yeah, thank you. And is anything in that someone else wants to elaborate on, or at some point that wasn't touched on? maybe.
I can maybe talk a little bit more about what a fund is and what a fund has to invest in. That was a great summary of the benefits of the program. So it's tax deferral up to December 31st, 2026. Partial forgiveness of taxes, up to 15% of the taxes you would have paid on those original capital gains. And then after 10 years, appreciation is tax-free. So in order to do this, you have to invest in a qualified opportunity fund. So the question is, what is that? You have 180 days from the point where you realize your gains to get that into a fund. A fund can be as simple as an LLC that you create. Let's say you have your own capital gains from the sale of stock or property. And so you can create an LLC that is taxed as a partnership. And then you certify that to the IRS as that this is a qualified opportunity fund. So this self-certification is absolutely key here, and this is really what distinguishes the Opportunity Zone incentive from a lot of other federal economic development incentives, because anyone can self-certify. There's no limit there's no competition, there's no allocation. Anyone can create a fund and self-certify their fund. So what we're seeing in the marketplace are a couple different kinds of funds. We're seeing kind of what I was talking about, these kind of single funds where, let's say you're a developer, you just sold a property, you want to take the capital gains from that sale and you are going to develop in an opportunity zone. So you almost do like a 1031. You take those funds, you invest them into your new property through this entity that's a qualified opportunity fund. Also, we'll see on the real estate side a lot of developers that already do equity raises for their developments. This is very similar. So they'll create a PPM. They'll attract investors for their projects, but those investors will come with capital gains, and they will invest through a qualified opportunity fund. At a much higher level, we're seeing regional funds that have been created, and then national funds. So these are something more akin to like a mutual fund, where we're seeing fund managers raise $500 million funds, $1 billion fund. And these are where investors with potentially maybe smaller amount of capital gains can invest them into this larger fund, not necessarily knowing exactly where those dollars are going to go, what they're going to be invested in. And those funds are then looking for investments all around the country. So that's kind of the three types of funds, I would say. Now, funds have they have to invest in certain things. This is an impact program. At its core, this is a program about impact. This is not about an investor buying a piece of property in an opportunity zone and sitting on it for 10 years and not doing anything with it. If you do that, you will not qualify. This is about making an impact on that property, and I won't go through all of the qualifications, but essentially a fund has to 90% of its assets have to be qualified property, and one of the keys to that qualified property is that the tangible property is either original use in the zone or it's substantially improved. And substantially improved means doubling the basis in the improvements in that property. So if we're talking about real estate, if a fund is investing in real estate, a fund cannot just buy a building and operate that building. That won't work. The fund has to purchase the property and then double the original investment in the building. And I say specifically the building because we know through various regulations or proposed regulations and guidance that have come out that let's say if you purchase a property for $1 million and the land is worth $500,000 and the building is worth $500,000, we know that you need to invest an additional $500,000 in order for that property to qualify as substantially improved. So you don't have to double the basis in the land, just the building itself. So again, this is about impact, and that's what we mean by that. Or you could qualify under original use. If a property has been vacant for 5 years or more now, and you were putting it back in service, that would qualify as original use. In that case, you wouldn't have to substantially improve the property. You wouldn't have to double the basis in the property. You could just put that vacant property back into use, and it would qualify. So that's some things within the real estate world that would allow your fund to meet that 90% asset test.
All right, well, yes, all very useful information, thank you. I think we'll bring it up over here to Fashad and talk a little about the, what are you seeing with, I know my question on here talks about around the state, but I realize you're much more familiar with Milwaukee. What are you seeing around Milwaukee itself with the opportunity zones that we have here? Do you know how many there are in the city, and are they being used as much as they could, or are there more opportunities out there for using opportunity zones?
Right. Well, remember that we do represent and do activities throughout the state, so I don't want to make it sound that it's just, WIDA just concentrates on Milwaukee, because that's certainly not the case. Well, first, just some quick things about Wisconsin Opportunity Zones. We were the entity that the governor assigned to select the opportunity zones in Wisconsin, and there are 120 zones. 37 are in Milwaukee, so a pretty decent amount of zones were selected in Milwaukee, because there are a lot of there's a lot of poverty, and also need for investment in many parts of Milwaukee. But in selecting these zones, we didn't just look at need, is an area, have high poverty or, other underserved characteristics. We also looked at the investment potential. Are these areas that perhaps investors would be interested in? Or can we do something in the selection to make these zones be attractive to investor? So one thing that we did was we made sure that 2/3 of the zones that were selected, and almost all of the ones in Milwaukee, are something called qualified census tracts for affordable housing tax credits. That way, it makes those zones even more attractive because for housing development, affordable housing development, because essentially developers can get a tax credit boost on those areas as well. So we really made an effort to try to see where we could blend those types of different opportunities. And also we got feedback from communities, including the city of Milwaukee and the redevelopment authority of the city of Milwaukee and MEDC, about which areas the city wanted to concentrate on for development, and tried to select zones that also blended with them. But to your question about, well, what are we seeing in Wisconsin? We've already seen projects that are targeted to happen in Milwaukee, but also we have had already 2 affordable housing tax credit projects that have blended opportunity zones with it. Just be aware that housing, especially affordable housing, is an attractive use of this program because first, housing developers, affordable housing developers, have a capital gain after 10 years. They normally exit deals after 10 years. So they have a capital gain tax issue that they want to resolve. So when they're exiting the affordable housing tax credit deals, this program allows them an opportunity to shield that capital gain and then have the new investment that they make with the money, as was noted before, be completely taxed, the new capital gain be completely, tax free. And one point I want to note about the fact that after 10 years, that new investment, could be sold and the full capital gain would have no federal taxes on it. You don't have to sell it at 10 years. You could actually go all the way to 30 years and get all of that appreciation and still have it all be tax-free. So there's no obligation to sell it after 10 years, and the appreciation benefit continues after 10 years. I'm just mentioning that for those that are involved in real estate. A lot of real real estate transactions have, investment horizons that are longer than 10 years. And you should just be aware that that particular benefit of the tax credit doesn't diminish. It actually increases over time. You have a full 30-year amortization, where actually technically, I think it's 2047 is the date. So, but just be aware that you're not required or forced to sell after 10 years to get the gain. You have plenty of time, based on whatever your investment horizon is for that real estate, But what we have been seeing is this really be used primarily for real estate projects and also for affordable housing. That's the type of deals that I've been specifically seeing.
Okay. Well, great. Very good overviews there from everyone. Now, I guess moving on to some specific questions. Brenda, we've touched on a lot of the advantages of the Opportunity Zone program, but are there any pitfalls out there that people need to be wary of before they dive right into this, either as an investor or a developer that you're aware of?
Sure. So, and I think just one more advantage that I just wanted to make sure that was being mentioned is that for the real estate side too, you are able to take depreciation. So, and what we see is that after you sell your investment after the 10-year period, you won't have a depreciation recapture. So that's really key to our real estate developers. I just wanted to make sure it was being mentioned. But as it comes to the disadvantages from the program, from what I could see, is that, you are going to have a tax due on December 31st, 2026. And what happens if you do not have funds available, cash to go and pay that tax due? You're going to have to try to obtain cash from another source in order to do that. Otherwise, another idea that I read is that perhaps the fund itself can issue like a debt finance distribution in order to give you some cash flow in order to pay for the tax due. The other thing that we've been advising our clients is that you are taxed at the capital gain rate at that time period. So right now, the maximum capital gains rate is a 23.8%. So you're hopeful that the capital gain rate is going to stay the same come the year 2026. However, there is a potential that it could be higher at marginal rates at that time. So that's another item we wanted to forewarn. The second thing is that keep in mind, this is a federal program. So, and states we're watching are slowly adopting the program. Fortunately, Wisconsin does adopt the program, but there's other states that do not. So, for example, like Hawaii and California, so far has not conformed to the program. So the concern is that for federal purposes, you'll defer the gain. However, for that state purposes, you're going to pick up the gain. And then when you recognize the federal gain in the year 2026, there's a potential that you can also pick up another gain at that time, or when you sell the investment, so you're going to have a double hit in tax. So when you're working on your projects, just make sure that whatever state you're filing in, just make sure that it follows the federal program. And the last thing was that, there is that minimum 10-year hold to get the maximum benefit on the appreciation, or as Farshad said, you can hold it up to the year 2047. But what we see with our real estate developers is that, they don't want to hold a property for that long of a period. They want to go and do a project and then flip it in a couple of years. So this is really a long commitment for them, is from what we've seen.
All right. Well, thank you. And on to the next question here for Farshad. What is WIDA's role in Opportunity Zones, and how can the people here, many of them I imagine are probably on the development and construction side, how can they get involved, maybe not as investors, but as people who would actually build projects?
Okay. Well, first, we are really trying to actively promote the use of opportunity zones for affordable housing. So, for example, especially for 4% affordable housing deals. So, for example, there is a new state housing tax credit that we administer, and we give extra points for projects that are in opportunity zones, and also even more points for projects that are in opportunity zones in rural areas. But the one thing that we are doing is essentially trying to give preferential treatment to projects, affordable housing tax credit projects that come to us for tax credits that are located in opportunity zones. And as I mentioned, for Milwaukee, there's a lot of areas in the community that, are within OZs, and that's just something to keep in mind. Just to really simplify, for an affordable housing tax credit project, we're net present valuing the yield benefit to be between 3 to 5%. So that's kind of your, when you're trying to model or do a capital stack, that's going to be the additional bump of doing your affordable housing tax credit project in an OZ versus not in an OZ, and of course having opportunity zone capital come in for the for the developer part of those types of deals. The other thing that we're trying to do to promote affordable housing and also link it with opportunity zones is also related to the 4% tax credit, and that is that we are providing subordinate debt that has a repayment based on the cash flow of the project rather than a fixed P&I, principal and interest payment, to again induce more 4% tax credit deals. One technical point: 4% tax credit deals, about 30% of the cost of a project, the qualifying basis of a project, is covered by the tax credit equity coming in from selling the affordable housing tax credits. So, but the thing that our product does is it provides subordinate debt so that not as much actual equity that normally will require double-digit returns has to be put in to the project. And also it makes the underwriting easier because, we're not having like fixed P&I payments the way the traditional bank would on the first position debt. And we're also not affecting the loan to value of, how the senior lender would do the deal. Now, in a traditional 4% deal, the first position debt would be 35-year, tax-exempt bonds with a fixed, interest rate. So again, very, very, very favorable senior debt financing. But we're trying to think of other sidecar types of products that we could put alongside the opportunity zone equity to make our opportunity zones in Wisconsin, more attractive to investors. And again, we focused a lot on housing because, again, for affordable housing developers, a lot of them will have deals that are exiting, and they don't have to be exiting in Wisconsin. They could be exiting in any part of the country. But we're trying to attract that investment in Wisconsin by offering, sidecar products and also incentivizing, making it easier to get the tax credits that we have available for those products that are in opportunity zone. But one disadvantage, because to kind of quickly go back to that question, I think, and it's a big one, and we don't have, I don't think Rebecca's group has yet solved this problem, but is the fact that we only have 180 days from when a capital gain is realized to when you have to invest whatever that amount of the capital gain is in an opportunity zone. And so far, that's been kind of a hard, red line, time period. And, so that's a real challenge. The one thing I would say about that for folks that have investments that are not affordable housing, right? Remember, again, that a lot of the housing developers that we have, the affordable housing developers that we have, will have these projects exit after 10 years. They don't have a choice. That's when they have to exit. So now they have a capital gain. They may be very open because they only have 180 days, to try to realize a tax shield for that capital gain. They may be very open to doing a commercial real estate deal or a construction deal that's not affordable housing, because for them, what's more important, at least their financial interest, is really in getting a tax shield, right, for that capital gain. So I'm just mentioning that housing developers, we believe, are one target group of folks that could really be a good source of investment for OZs in Wisconsin, and we certainly have some top-tier housing developers that are Wisconsin, that are Milwaukee-based or do a lot of business in Wisconsin, in Milwaukee. But one other quick point. I'm sorry. Another thing that we're going to do, though, is we're going to developing the expertise on how to structure these opportunity zones can be expensive. And so one of the things that WIDA is thinking of doing is hiring the best consultants that we can, legal consultants, people like Baker Tilly and Hush Blackwell, to give us advice and counsel on some structuring models, on how to set up this stuff. And we'll make those available to the public. So technical support and promotion of this program is something that we'll be very involved with, because as some of the other panelists have mentioned, this is a perishable resource. Each year that this passes, if they don't change that, the 2026 date, the tax benefit from OZs diminishes. So it's very important that we try to get as much investment done in the next couple months, if possible.
All right. Well, thank you. And moving on here to Rebecca. I think we were talking a little bit out in the lobby there about how, for you, this is an interesting new area in the law. It's fun a little bit to work on something new. But are you finding among your clients that there are a lot of people who are interested in this, and are you getting a sense that there's a rush to take advantage of this, or do you think that there's still lots of potential out there for more people to take advantage of it?
There's an incredible amount of interest. I mean, never in my practice have I gotten cold calls just from random people wondering what this is and what they should do about the fact that they own property in an opportunity zone, or they have these gains and they want to know how to take advantage of them. It's really pretty extraordinary. The law, when it was first, the provision when it was first passed at the end of 2017, was really kind of the skeleton of a law. It left a lot of questions open as to how this will actually work in practice. We felt that there was a certain type of really vanilla deal that could be done, something similar to what I was talking about previously. If a developer takes its own gains, puts it into a fund to do its own development in an opportunity zone, and so those, we've been working with clients on those kinds of projects for quite some time now. Treasury let it be known that they understood that there was a lot of questions out there, and that they would be issuing guidance. So in October of 2018, the first round of guidance came out. We thought that this was going to be the guidance to end all guidance, and it turned out that it was just interim guidance, and there would be more to come. So that guidance clarified some aspects of how things would work, but there was a sense, especially on the part of these large funds, that the program wasn't ready to work for a $100 million fund, a $250 million fund, with multiple assets. That we couldn't, there were some, that the way that the incentive was structured caused impediments to the actual functioning of a fund like that, how the exit would work. There were significant issues to overcome still. So while we have this kind of ticking clock to get the full 15-year forgiveness of the capital gains before December 31st, 2026, there's also this hesitation that we're, at least when it comes to large multi-asset funds, where the capital is really going to flow through this program, that those were kind of still stalled, waiting. The second round of guidance came out in April of 2019. That round really clarified for those large fund managers how an exit of a multi-asset fund would work. And so while there are still, again, this is proposed guidance, so this still is the guidance is not firm, although Treasury has said, except with some exceptions, that we can rely on the proposed guidance. But so that has really gotten more of these deals flowing. So I would say there's both a sense of urgency and a sense of caution at the same time. We are certainly starting to see deal flow pick up, and the clients that are talking to us about this are from all ranges of background. So we have, real estate developers that are incredibly interested in this. We have just property owners who own property in a zone. We have municipalities. My firm has been doing a lot of counseling of municipalities. What's their involvement? So we have a zone in our city. What does that mean? How do we take advantage of that? To banks who are curious, well, what does this mean if I'm a real estate lender? How can I be involved in this? To fund managers, people are coming at this to investors from all different areas. So the questions have been many, and we're starting, I think, to see a real deal flow from it. I wanted to go back. Farshad raised the issue of timing, that you have 180 days to invest in the fund, and that the timing is definitely a complexity of this incentive. But I do want to make clear that you can invest in a fund, and then the fund has at least 180 days to hold your investment before it has to count to this 90% asset test. So if a fund is just sitting on cash, it's going to fail that asset test, but because the cash is not qualified property. But the fund has at least 180 days. It could be up to a year, depending upon when your fund is organized, to sit on that cash and figure out what it's going to do with it. And then there are safe harbors, depending upon what kind of investment you do. If you invest into a business, that business can hold cash for 31 months pursuant to a plan for its use if you have a schedule and you follow that schedule substantially. Or if you're investing directly into real estate, you have 30 months for substantial improvement of that real estate. So while you do need, as an investor, you need to get your gains into a fund within 180 days. The fund itself then has some more time to figure out what it's going to do with that, and then even once it figures out what it's going to do, it has more time to actually turn that cash into qualified assets.
Okay, well, great. And similar question for you, Brenda. What sort of activity have you seen since this program began to be offered?
Yeah, so very similar to Rebecca, a lot of our clients were very hesitant to get started in the Qualified Opportunity Fund as well as the Opportunity Zone deal itself. Now keep in mind, the Opportunity Zones did not get finalized by the governor or the Treasury itself until April of 2018. So it still even took some time for these zones to be qualified, for them to even figure out, okay, am I in a zone or not? So that's one thing to keep in mind. And then, as Rebecca mentioned, the first set came out in October of 2018, and the question is, well, what do we do with this? For my clients, the biggest question that they had was that, say I invest into a qualified opportunity fund, and then I'll get a priority distribution of that investment. Now the question is, was that considered a sale of my investment, and am I going to be picking up a gain for it? And fortunately, when the second set of proposed regs came out, it said, no, that would not be considered a gain or an inclusion event as long as you have basis to go and support that. So one thing that gave them basis was the debt. So if you did like a debt finance distribution, you would be fine in that regard. So I think that gave some comfort level to our real estate developers that we had. And as Rebecca mentioned too, I think we're going to see a lot of influx of Opportunity Zone investments happening this year, especially before December 31st, 2019, just to make sure that they're going to meet the 7-year period before they have to pick up the gain on December 31st, 2026.
Thank you. And I think I might skip ahead to Farshad here just to keep the flow going this way, and then circle back around to Rebecca.
Okay.
So the question I had for you, Farshad, is you've been to national conferences on opportunity zones. What's the general feeling? You think Wisconsin is ahead of other states or lagging behind?
Well, I think in housing, we may be either in the middle of the pack or a little bit ahead. In economic development, probably a little bit behind. what we've seen, what are other states doing? At least in the housing side, you'll see that there are other housing authorities like us that are giving extra points in the qualified allocation plans for, opportunity zones. I think the one thing that makes us unique is we're probably the only housing authority that has like a product that can be blended well with 4% tax credits. I didn't see that in the National Governors Association meeting that I just went as Wisconsin's, representative. On the economic development side, though, there are other states that have been incredibly aggressive. So, for example, in Maryland, and in Ohio, they're even providing credit enhancements to deals that are done in opportunity zones, either protecting the collateral or even guaranteeing a return for deals that are in opportunity zones, just to show you, how aggressive some of these states have been. And there has also been a directive in many states to give preference in all of their grant programs or any type of financing programs that the state may offer. That, by the way, that's something that at the federal level is also kind of trying to be coordinated with a council that was set up to try to promote opportunity zones and get more interagency cooperation. But that's another thing that we've seen from other states is really giving preference throughout all of the state's programs to opportunity zones. And again, in Maryland, that is an actual legislative, action that was taken. And then we've also seen other states that have set up specific opportunity zone, resources, primarily funds of some sort to promote these. Another thing that we've seen other states do is set up OZ-specific websites, to have exchange of information. But also some states have already set up websites or programs that are kind of exchanges. Some states even have hired what was being called deal jockeys to try to put together investors who have capital gains with possible projects. So, and we've even seen, like in Utah, the state contracted with the Utah Counties Association, kind of a third party, to be this deal jockey for rural deals, which is an area that at least the state of Utah is trying to promote. And they just thought that there was a need to be very proactive in trying to act kind of as a handmaiden or as a broker between between investors and possible deals that communities have. The last thing I would say is that some cities, like Portland, for example, have been incredibly proactive in promoting the Opportunity Zone program, and again, establishing Opportunity Zone specific incentives for projects in the city. I think we're hopeful that in Wisconsin we'll have some of our cities, especially Milwaukee, do something of that that would also be very proactive to try to promote opportunity zones, especially in Milwaukee because of the number of opportunity zones that were selected in this community.
All right, well, thank you. And as I said, we'll move back to the end of the table with Rebecca. And, something that I'm sure people are curious a little bit about is there's all sorts of economic development incentives out there, namely TIF districts, tax increment finance districts. How do opportunity zones differ from those?
In a lot of ways. So one that I already mentioned, this is self-certifying, and there is no maximum or minimum. There's no cap on the incentive. So Farshad said at the outstart, we're talking about $3 to $6 trillion of wealth that could be invested into opportunity zones. Could be very dramatic. Two is that this is not only a real estate play, this is also a venture capital, private equity play. In fact, a recent national conference that I was at, someone from CDFI said that they would consider this program a failure if it became only a tool for real estate development. Three is that this is equity, it's not debt. And a lot of real estate developers that are used to working with alternative finance tools are used to working with some sort of grant or subordinate debt. And this is a very different product. This is all private capital. There is really no government involvement in this program. At least there's no local municipal government involvement in this program. There are designated zones. That's really it. What Farshad is talking about is when he's talking about municipal and state, local government involvement, he's talking about municipalities looking at this and realizing that in order to get people to invest in these zones, they're going to have to create products essentially to sweeten the pot. And so in that regard, if you're looking at developing it in an opportunity zone, you should absolutely be thinking not only how do I get opportunity zone capital into this deal, but you should be thinking about what other products are available to me because I'm doing an opportunity zone development. So you should be reaching out to the municipal government, to local CDFIs, to WEDA, to WEDC, to see what's out there because you're doing an opportunity zone development. But you also need to realize that because this is equity, there are securities implications. You cannot just, well, you can, but I wouldn't recommend it, put out, start asking a whole bunch of people for money for your development. This is, you are selling an interest in an entity, and that is a security. So you need to be cognizant of securities laws, and you need to make sure you find good counsel to help you navigate through those. And that is really, I think, a larger, when it comes to on-the-ground developers thinking about how to take advantage of this program, if they're not already doing private placement memorandums and raising private capital, it's a whole new world, and that's somewhat intimidating to them. So if this is something you want to take advantage of, you have to make sure that you have good legal counsel to do that. And then but for those developers, I think, that don't want to do a PPM and do their own raise, what you're looking for is you're looking for a fund that's already out there that's looking for something to invest in. A lot of those funds these larger funds are coastal, and they're looking for large projects. If you have a $500 million fund, you don't want 500 $1 million investments. You want 10 $50 million investments. So the challenge, especially in Wisconsin, is how do we get outside funds to be attracted to our projects, especially projects that are mid-level, mid-size, or smaller. It is happening. We do know that in Green Bay, an outside fund has invested in a Green Bay project and wants to do a phase 2 of that project. So certainly investors and funds are looking at Wisconsin, but this is really a dramatically different kind of incentive that many developers are it's going to put them in a whole different set of waters. And so it's something that you really need to proceed with caution as you go into it.
All right. Well, good warning there, or something to at least consider before you dive into one of these projects. Let's see, where was I? Oh, yeah, Brenda. So dates are now being mentioned in order to take advantage of the program. Do you think any of those will be moved eventually? I'm talking about the tax recognition date of December 31st, 2026, or making an investment by December 31st, 2029 to benefit from the 7-year provision, which I'm hoping you'll explain what that provision is.
Yeah, so the 7-year provision, as I mentioned, is that in order to benefit for the full 15% exclusion of the gain, you have to have your investment in before December 31st, 2019. So there is proposed, and I'm going to emphasize proposed legislation to go and move that date from the end of 2019 to 2020. The original authors of the 2017 Opportunity Zone Bill, Senator Tim Scott of South Carolina, has plans to introduce a bill to extend the key deadline before the August recess, and he's working with the Senator Cory Booker from New Jersey on this issue right now.
Well, thank you. I have a few general questions here, but also I'd like to open this up to the audience if possible. So maybe we should do a Q&A now and then circle back around to the general questions if we don't have many, just in interest of saving some time here. You want to do that? Yeah, does anybody have any questions? Joe? We can always go to those general questions if we don't have any. Wait, okay, go here. Right. Oh, okay. Well, I bet it might be of interest to everybody what your question is.
Just to clear up, Brenda, you had mentioned that if you need to reinvest gains from a sale this year, that you need to do it within the next couple of days.
That
Is
was, no, that was for, so say you had a sale that happened in 2018, so it got represented.
Oh, if it was in 2018. 'cause you need-
2018, and say the recognition date is December 31st of 2018, and what qualifies as the December 31st recognition date would be if you have any net 1231 gain, or say you got a K1 that had like a capital gain on it, you can use your December 31st, 2018 date, and then 180 days from that would be June 28th, 2019, so this Friday, you would have to go and invest your
Okay,
gain into
I
a qualified
misunderstood that.
opportunity fund.
Okay, thank you.
Anyone else have a specific question for the panel, or before I hop back up there and ask some more general questions? All right, well, we must be covering all the bases then. All right, well, here's a question for the group that anyone's welcome to take up first, and then the others can elaborate on. And I think we touched on this a little bit, but what are some ways that opportunity zones could be better used in Wisconsin? Do you think that they're being neglected in some ways in certain places, especially? That might be a good question for Rashad. And are they less common in other states, or is this just perception? I think I read articles, you mentioned City of Portland, for instance, seems to have quite a few. And if that's the case, why is that so? Maybe it's a question for Rashad to start on.
Well, I would want to emphasize that for the program to really be successful, local community leaders are a key component in this, because it's local folks that know the high net worth individuals or local corporations that might have capital gains, and they can identify those folks or those local companies that might have capital gains for us technical folks to talk to and let them know how they could have a tax shield or a tax benefit that would help them on the tax side. But there's no way that I know who in Racine or Milwaukee specifically may necessarily, or in other communities, let's say in La Crosse or Oshkosh, who are the high net worth individuals there, or who are the local corporations there that might be able to benefit from this program. It's those local community leaders that know those folks, and also the local folks know the local projects as well that could take this investment as well. And in fact, for municipalities, in many cases, there are projects that they want to promote with TIFs or other resources, and but you can't use the opportunity zone benefit without having an investor that would come in. So we really do need to advertise and promote this program more, but especially with those local influencers that can help us be the kind of the brokers to put together local investors with especially local investment opportunities.
Yeah, please.
I think just in terms of how many zones there are, and some are getting more attention. So first, every state could designate the qualification as a low-income community, which is based on certain parameters in census tracts, and each state could designate 25% of their low-income communities as opportunity zones, with 5% of that potentially being zones or census tracts that are contiguous to these low-income communities. So, a larger state is going to have more zones, but per capita, it should be pretty similar across the board. One of the reasons that certain zones are getting more attention than others is because certain zones are, I've heard fund managers talk about the top 10% of opportunity zones. And by that, they're looking at, what are the zones that these are low-income communities, or they're designated as such, based on the census that was 10 years ago. So what are the zones that we're going to make the most money in, basically, right? Right now, the vast majority of fund managers out there that are doing large raises for opportunity zones are not looking at, rural communities or impact funding. They're not paying attention to the 30th Street Industrial Corridor in Milwaukee. They're paying attention to the opportunity zones in Brooklyn, where they're going to build their $200 million high-rise, or in Queens, or in downtown Portland, where there is an opportunity zone because there is a large senior housing project in the census tract that pulled down the income levels in that census tract. So that is definitely a story that's being told now, is how much of the opportunity zone capital of these dollars, the significant number of dollars that could be pulled from these investors into these low-income communities is really going to go into communities that don't really need this and just benefit investors. That is a huge reason that it is incumbent upon local municipalities and state governments to incentivize and to use carrots and sticks to set the terms of the kinds of investments that they want to see in their communities, and to create exactly what Farshad was talking about, to think about who their local investors are and the projects that they want to see done, and figure out how to connect the cash to the projects. Because that desire is out there, but these large funds that already know how to raise money and already know how to do huge real estate developments probably are not going to be looking in a lot of our communities.
Yeah, I do think it's a fool's errand to try to go after those big funds, except for some rare, really large, high cap rate projects. But finding, high net worth individuals or corporations in local areas that have capital gains, these folks probably have never heard of opportunity zones. I mean, it's not even under radar, but they have capital gains that could benefit them greatly, and could also benefit, it could be a win-win. It can benefit their community by providing resources for those for projects, very high impact community projects. And that's why it really is important to try to identify those folks and let them know of the opportunity and opportunity zones, because I really believe there are quite a few local corporations or local individuals throughout Wisconsin that, if they knew about the program, would take advantage of it.
All right, yeah. Do you think there's a public information campaign that's going to take place or something like that, or is it more about targeting certain individuals?
That's what we're doing right now.
Yeah, right.
Yeah, exactly.
Yeah,
We
so,
all
yeah,
are.
right, exactly.
We are.
Well,
I think we're
we got
all
one high
trying
net
to.
worth individual right here, so
We're trying to, again, set up information sessions, but also trying to, even where possible, work with municipalities or communities to set up community-specific events where we and other technical folks can talk.
Okay, well, great. Wait, I think we have a question over here. I'm gonna bring this microphone over.
How you doing? Chris Kemp, 30th Street Corridor. You mentioned, Rebecca, about funds being established where there's a difficulty sometimes with regard to a commingling of asset funds, basically. Is it more advantageous to have like a singular asset, like a multifamily fund, a commercial fund, a retail fund, so that it's delineated out that way?
Yeah, when I'm talking about multi-asset versus single-asset funds, I'm actually talking about a fund owning one project, not just one asset class.
I see.
There was concern that it would be difficult because of how the provisions are written to have an exit at the end of 10 years, because as investors and developers, whoever's doing this, you need to know how you're going to you're going to have your investors exit. How do they exit if the fund owns more than one asset? And so that's been largely clarified. There still are funds that are being set up to be, maybe it's actually each individual project is a separate
like a
fund,
single asset entity,
right?
basically
But
established.
there's maybe an overarching asset management agreement that covers them. So
Sure.
there's a lot of different ways to set it up now,
Yeah.
but there is no reason there's no reason that you couldn't mix asset classes other than, potentially that's what you're
Sure.
interested in doing
Okay.
is having a multifamily fund, as part of your marketing.
But that's a really important point. You know how a real estate developer sets up an individual LLC
Sure.
for each of their own projects? I really, don't get caught up with the word fund.
Yeah.
A single project fund is really just an LLC. That's what
Sure.
it is,
Okay.
The fund is just a word.
Right.
It's just
Okay.
a boring real
Okay.
estate
Yeah,
LLC.
'cause I'm
But
starting to
boring
think
is good.
portfolio manager
Right,
and
right,
he's gotta
right.
have a
Now,
CFA
and also
and-
a manager,
Yeah.
don't get caught up necessarily on having that manager be like, Baird, or those types of
Yeah.
guys. It could just be like a real estate developer that oversees all of these individual LLCs the
Sure.
same way a real estate developer
Sure.
does, right?
Sure.
Because the reason I want to kind of emphasize this is this single, single product LLC model, very simple.
Yeah.
And no offense, Rebecca, but, low legal costs as well.
Yeah,
It's very simple.
Yeah.
And we also, we have a kind of a perishable resource. We don't want, it takes time to set up like a fund with
Huge
multiple,
structure, yeah.
you have to
I used
work.
to work for Freddie Mac, so I'm
Okay,
familiar
so,
with seeing those things.
so I just want to emphasize that this program has a very simple structure available for, and it can also be small investors.
Yeah.
It could be something as small as 20 or 30,000, under this structure. The transaction costs are really relatively low
Yeah.
for that type of investment.
And I just wanted to make a point too, just from a marketing standpoint, those organizations have to promote themselves that want that an investment like 30th Street Corridor. We're going through a process now where we're going to make our first venture into a large real estate development project. So we got to get it out there to say, hey, we need equity investment and that kind of thing. So it's incumbent upon the marketing side. So.
Thank you. Thanks for the question. Anybody else before we wrap up here with one more question? I think for the whole panel. This is I think just a general question. Where do we go here with opportunity zones? What do you think the future is? And also there was a specific question about any kind of corrections or additional addenda that are needed,
Sure.
which I think we can loop in with what the future is for opportunity zones. So maybe you can take it first, and then the others can chime in.
Yeah, happy to. So, as you alluded, I think we're still waiting on a third set of proposed regs to come out. I think we're waiting on technical corrections as additional guidance as it relates to it. The first of which is 1231 gain. You asked the question again about that you have December 31st is what they consider to be a net 1231 gain to start the 180-day period. The concern that people had is what happens if they took advantage of the program early in 2018. So say they thought they had just a 1231 gain itself of $2 million, and then maybe in like March, so they did their investment 180 days from there, and then they found out in December, well shoot, I have a 1231 loss of $500,000, so now I should have only invested 1.5 million, but I already vested $2 million earlier in the year. Now what happens? A couple of days ago, the IRS actually updated their fax Q&A website to go and say that, well, if you did your investment earlier in the year for 2018, that's fine. That's still considered a qualified investment. However, they did not clarify if the net is still in play. So what might happen is that you'll have like a mixed fund where they over-invested by $500,000 because they should have done the net for that. So we're waiting on corrections for that. We're also a little concerned because if they do not extend the date, I think it's going to be a crazy New Year's Eve this year because if you want to make your investment by December 31st to go and follow the 7-year period, but then also you have to wait till the end of 2019 to start your 180-day clock for the net 1231 gain to go and do your investment, what do you do? Is everyone going to be investing on that same period? So that was a concern that we had for it. You asked the question about the assets of it, and Rebecca highlighted too about to set up a qualified opportunity fund, you know, the asset has to be original use or you do a substantial improvement. Right now, when the IRS discovered or explained about substantial improvement, they said it has to be an asset by asset basis. So the concern that we have is what happens if you have a development that has multiple buildings associated with it, and say one building needed more renovation versus the second building. You know, can you trickle? And as it stands right now, they're not aggregating those buildings together. You have to look at each standalone to do the substantial investment. So that's another technical guidance we're waiting for. The proposed regs confirmed that leasing real estate is considered a trade or business activity. However, they specifically excluded triple net lease. They did not define what a triple net lease is, and you'll see that in a lot of our historic projects. When the proposed regs came out for the 20% deduction that pass-throughs are allowed, they gave a definition of triple net lease. So we're hoping when the third set comes out that there'll be a definition for it. And then the last one that I wanted to mention that we're looking for guidance is that, you know, it was mentioned that there's a fund manager, and the fund manager could be soliciting contributions for their project. So say as an investor, you want to do a contribution into this fund. And before the manager decides to move forward on the project, they want to meet a certain threshold in order to deploy the project. And what happens if they don't meet that level? So the fund manager goes back to you and says, hey, I'm sorry, but we didn't meet our investing requirement, so here's your money back. And it could be close to that 180-day period. Well, as an investor, the proposed reg said, you know, if you have a sale or disposition of your entire qualified opportunity fund investment, you have an additional 180 days from that time period. Would the return of capital be considered a sale or exchange of your investment? You know, will you get 180 days? And I think we're waiting on clarification. But as Rebecca mentioned, you know, you do have other avenues that you can use to go and get the additional 180 days. And like I said, at Baker Tilly, you know, we are writing a letter to the Treasury with these issues as well as other issues that we see needs technical clarification and guidance. So that was...
Yeah, and Prashad and Rebecca, if you guys have anything to add to that or want to talk a little bit about where you see opportunity zones heading in the future, are they something that will have to be reauthorized in some sort of future tax bill, or are they permanently here, or what's...
Well, December 31st, 2026 is going to be the end of the deferral period unless there's legislative action to change that, which is certainly being discussed. However, at this point in time, that's what we're looking at for the end of the deferral period. That is not to say that you need to invest by December 31st, 2021 in order to get some of the partial forgiveness of your capital gains tax. But you can invest in an opportunity fund through up to the end of 2026 and still get the 10-year tax-free appreciation benefit. So there is a long future for this program, a fairly long future for this program, even if that December 31st, 2026 date never moves. I also think that, you know, in terms of the future of the program, the more deals that happen, the more deals are going to happen. This is really, this is a completely new incentive. It's a little bit like the Wild West. As more deals are worked out and are modeled and templates are created and processes are established, then that's going to encourage more deals to happen. So I think we're in the very beginning of that process, I'm hopeful that we, all of the technocrats here can work together to figure out how to create workable, efficient, inexpensive ways to do to really help the capital flow into our communities.
Do you want to anything for Shad, or should we?
I would just highlight that this program is very bipartisan. So you have, a very conservative senator and, Tim Scott allying with, would be considered a progressive, senator with Cory Booker. But also Ron Kind, for example, was one of the co-sponsors of the original House bill as well. So I'm cautiously optimistic that there's possibilities for having, technical correction bills that kind of make the program work better, and that the extension of deadlines or tweaking is actually something that could potentially be done, legislatively for that. I do want to mention just one policy issue. You may say, oh my goodness, is this like a $3 trillion, tax, giveaway? Well, one of the things that this program really wanted to do was have folks, instead of figuring out all these ways that Baker Tilly has helped folks defer, capital gain, right, so that they just defer the eventual payment on a capital gain, encourage folks to actually take the capital gain and actually invest it in low-income communities. So one of the purposes of this bill is to actually get folks to realize capital gains, and then we'll have that resource to invest in low-income communities. If we did nothing, if this didn't exist, those gains would just stay unrealized, most likely. Or at least there'd be strong efforts to do so.
All right. Well, on that note, unless anyone has a question, I think we'll wrap up here. But I want to thank our panelists again. It was very informative. I know I learned a lot, and they'll be around here afterwards. If any of you want to approach them and ask a question directly, I'm sure they'll be happy to oblige. But thank you again.